हेलो एवरीवन, हाउ आर यू? कैसे हो आप लोग? उम्मीद कर रहा हूं कि आप लोग बहुत बढ़िया होंगे. आई होप ऑल ऑफ यू आर रियली गुड. सो दिस वीडियो इज फॉर ऑल माई CMA intermediate students, right? And this video is on your mock test paper, right? Model question paper for paper number 8, that is cost accounting, right? So as promised, we are going to discuss this. This model question paper is for which term? For June 2024 term. And please let me know in the comment section if you want the previous terms also. For December 24 also, there were 2 sets of the mock test paper. If you want the discussion for that also, please let me know. The video is going to be in simple English because there are lots and lots of students from the southern part of India, right? But very simple, all of you will be able to understand it. Okay, now how we are going to proceed with it, give me just 1 minute. I'm going to explain it. In this particular videos, we are not going to take up the MCQ part. The MCQ part I will be making the separate videos on that, right? I'm combining all the MCQs from the mock test papers of this part, or the earlier syllabus also, 2016 syllabus also, from wherever I can get. I'm combining a few MCQ parts, right? MCQ session we will take up separately, and in this part we'll be taking up only the practical questions. Now important here is, when we are discussing about it, what is the most important part? The most important part is to understand those areas where we can commit mistake, where we have to be more careful about. I know 90% of you will be able to attempt all these questions, whatever the questions are there. 90% of you people can attempt it, right? It is not that difficult. But what is the difficult part is to understand and to know that in the examination, when we are under so much of pressure, when the time is limited, what are those areas where we need to be more careful about? What are those areas where we need to avoid the mistakes? That is what is going to be the main agenda of discussion, right? And as I told you, please let me know if you people want it for the December 24 also. MCQ sessions will also be there in the next coming days only, right? So please guys, support your own channel. Already you people have shown a lot of support in the last years, right? And I really hope all of you will share this video with all your friends in all your circle, wherever you can, right? And please do subscribe to the channel for the regular updates, right? And we'll be definitely coming up with the CMA content also. Don't worry, CMA students are often complaining that, sir, you do not come up with the CMA content, but I will be coming up with the CMA content, right? And we'll go hand in hand like this. Okay, so let's start. The first part is the MCQ part. I'm leaving that right for now. Okay, second part, question number 2, attempt any 5. Section B, section A is MCQ, section B is answer any 5 questions out of 7 questions given. Each question carries 14 marks. So you have choice. You have a choice. That's really good thing for you. Okay, question number 2, A part, but we are not going to get we are not going to discuss only the choice part. We are going to discuss each and every question. M&Q LLP submits the following information on 31st of March 2024. Based on the given data, illustrate and prepare a statement of cost, right? That means what you have to prepare is, you have to prepare cost sheet, sir. As simple as that. You have to prepare what? You have to prepare the cost sheet. What is the data given? Sales for the year is given, inventories at the beginning of the year, finished goods is given, and WIP is given. Purchase of material for the year. Which material, sir? Purchase of raw material for the year. Obviously, if you are a manufacturing concern, what will you purchase? You will purchase finished goods or you will purchase WIP? No, you will purchase raw material. Material inventory at the beginning of the year, at the end of the year. That means he is talking about the raw material inventory, right? Great. Direct labor is given. Factory overheads are 60% of the direct labor cost. Okay, inventories at the end of the year, finished goods, WIP, other expenses, selling expenses 10% of sales, and administration expenses are 5% of the sales. So very simple, you just have to prepare the simple cost sheet, sir. Nothing as such hi-fi in this. All the information is already given to you, right? You just have to prepare what? You just have to prepare the cost sheet. Now, while preparing the cost sheet, you will start with what? You will start with the direct material consumption. for that, what we are going to take is opening material plus purchases of the material minus the closing stock of the raw material, that will give you the raw material consumption, plus direct labor, that will give you what? The prime cost, because there are no direct expenses. Then factory overheads are given 60% of the direct labor cost, that will give you the factory cost. Then you will make the adjustments for the WIP, the opening WIP and the closing WIP, that will give you the net factory cost, right? Then you will add if there are any expenses which are related to your production, that is cost of production. If there are no expenses, then you will make the adjustment for opening finished goods and the closing finished goods, that will give you what? The cost of goods sold, right? In the cost of goods sold, you will add your selling expenses and administrative expenses, that is as a percentage of sales that is given to you. You will get cost of sale. The sales are given, cost of sale you have calculated, the profit you can get, right? Now the important point here, just be very careful with one point. Administrative expenses, sir, nothing is mentioned that whether these administrative expenses are related to production or they are related to the general administration expenses. It is not mentioned in the question. Then how to treat it? Sir, you have told that we can take it anyways and give a note. Yes, I have told you that, but there is some sort of the common sense that we people can apply while identifying. See, the administrative expenses are given as a percentage of the sales. Now if it is given as a percentage of the sales, then you have to take it as general administration expenses, right? Had it been that administration expenses would have been given as a percentage of, let's say, the works cost or the prime cost, then we can take it as administration overheads related to production, right? If nothing is mentioned, if it is only given administration overheads, that's it, nothing is given, the value is given administration overheads 10,000 rupees, then in that case how it should be taken? In that case, under the normal circumstances, take it as general administration overheads and give a note at the bottom. Clear? So this was an important point that I wanted for the discussion. Now 7 marks, very easy question on the cost sheet. Next part, material costing. Anil Limited buys the annual requirement of 36,000 units in 6 installments. This is what they are doing. What they are doing is, sir, they need 36,000 units in the whole year. In the whole year, they need 36,000 units, right? And they are getting it in 1, 2, 3, 4, 5, 6 installments. So every time they are ordering how many units? 6,000 units. Isn't it? If they are ordering in 6 installments, that means every time they are ordering 6,000 units. That is why total in a year, right? This is what the order quantity per order. Order quantity per order. This is what they are doing currently. Okay. Each unit cost ₹1 and the ordering cost is ₹25. The inventory carrying cost is estimated at 20% of the unit value. Compute the total annual cost of existing inventory policy. Cost of existing inventory policy. Determine how much money can be saved by using the EOQ. Right now, for that you will have to calculate, but first you have to calculate what is the annual cost of existing inventory policy, right? If you talk about this existing policy, what will be the cost related to it? I will talk about the annual purchase cost. Annual purchase cost. How many units you are purchasing? 36,000. What is the cost per unit? That is ₹1, right? So total cost is 36,000. Next, annual ordering cost. What is going to be your annual ordering cost? How many orders are there? It is given in the question that they are ordering in 6 installments. So that means the 6 orders are there, right? And what is the cost per order? Ordering cost is 25. So here it is 6 multiplied by 25. 150. Right? Now what will be the annual carrying cost here? What will be the annual carrying cost? Average inventory. What is the average inventory here? What is the order quantity? Order quantity is 6000 units. 6000 divided by 2. This is my average inventory, that whatever the quantity I am ordering, मैं जो भी मंगवा रहा हूँ, on an average how much of that quantity I am carrying in my store, right? So it is the order quantity divided by 2, whether it is at EOQ or whether it is some other quantity that I am ordering, multiplied by the carrying cost per unit per annum, that is 20% of 1 rupee, right? So it will be 600. So what is the total cost here? That is 36,750 rupees. This is the cost of the existing policy. Now he says, will there be any savings if they go for EOQ? So that means you will have to first calculate EOQ, sir. What will be the EOQ in this case? 2 multiplied by, what is the annual requirement? 36,000. Ordering cost 25 rupees. Carrying cost 20% of 1. Right, so that will be under root of multiplied by 25, that comes to 18 lakh, right, divided by 0.2. So 18 lakh divided by 0.2 under root of that, that comes to 3000 units. Now calculate the cost at 3000 units. Calculate the cost at 3000 units. What will be the cost at 3000 units, sir? Will there be any change in the annual purchase cost? Will there be any change in the annual purchase cost? No, sir. That will be 36,000 multiplied by 1, that will come to 36,000. Right? What will be your annual carrying cost? No, sorry, ordering cost first. We'll take ordering cost first. Annual ordering cost. Now 36,000 annual requirement divided by EOQ, that is 3000, multiplied by 25. 36,000 divided by 3000 multiplied by 25, that comes to 300. Next, annual carrying cost. What will be the carrying cost, sir? That is 3000 divided by 2, that is average inventory. EOQ divided by 2. Whatever you are going to order quantity divided by 2 multiplied by 0.2, right? 300 plus 300 plus 36,000, that comes to 36,600. Is there a savings here? Is there a saving? Yes, sir, there is a saving of how much? Saving of rupees 150 if you go by EOQ, right? If you go by EOQ, there will be a savings of rupees 150. Now, one very interesting fact that you should remember for the MCQ purpose also, whenever we are talking about the EOQ, at EOQ, one thing you have to remember is that your annual ordering cost will be equal to the annual carrying cost. This is for the MCQ purpose, that you should remember that it will always be there until and unless there is due to some calculations or due to some decimals there is a difference, that is a separate issue. Otherwise the annual ordering cost will be equal to your annual carrying cost, right? So this you people have to remember. So with this we are done with these two parts, right? B, I have solved it fully. There is a savings of 150 that is there. Okay, now next one. A manufacturing unit produces two products X and Y. The following information is furnished. Product X, product Y, units produced is given, units sold is given, machine hours utilized is given, design charges, software development charges, royalty paid at the rate of 54,000. 2 per unit sold. For every unit sold there is 2 rupees royalty that we are paying for both the products, right? Royalty paid on the produced part is also given, 35,000, that is at the rate of 1 per unit produced. Higher charges for the equipment used in the manufacturing process, 5,000 only for X. Compute the direct expenses. Simple. Design charges, yes, a direct expense. Software development, yes. Royalty, a direct expense. Royalty on purchases, a direct expense. Production, the higher charges are direct expense. Now this machine hour, this is clearly an overhead, sir. For the machine hours, we are not going to take anything. Machine hours is a overhead, right? So not relevant for our discussion. Let's see. Royalty paid on the sales, yes, is taken up. Royalty paid on units produced, higher charges for only product X 5,000, design charges are there and software development charges are there. Direct expenses, total value is there. Clear? Machine hours are not required to be taken because machine hours are anyhow what? They are your overheads. Clear? Now let's come to part B of the question. Very simple part B, that is on cost accounting systems. Prepare and pass the journal entries for the following transactions in the double entry cost accounting system. Issue of material, direct material, and the indirect material, that is issue of material from the store. Direct material will be WIP to SLC and indirect will be factory overheads account debit to SLC. Clear? Allocation of wages and salaries, allocation, not incurred. He's talking about the allocation of wages. Direct wages, where will you take direct wages, sir? Direct wages will be directly taken to WIP only, WIP to wages control account, and indirect wages will be taken to factory overheads to wages. Clear? This is how the journal entries will be. Now the next journal entry, please read it very carefully. He's saying overheads absorbed in the jobs, overheads absorbed in the jobs. Read the words very carefully, that what is the requirement, right? Absorption of overheads. Factory overheads, where will you absorb the factory overheads? These factory overheads will be absorbed to WIP, right? Sir, administration overheads, finished goods to admin overheads. Sir, selling and distribution overheads, where do you take it in the cost sheet? Remember, I have told you in the lectures also, selling and distribution overheads, where will you take it? You will take it to cost of sales account, right? Then next is under or over absorption of overheads. Now this is interesting, sir. When you prepare the overheads account, right, here you take the incurred part. Let's say incurred is 10,000. On this side you take the absorbed part. Let's say the absorbed is 20,000. Now this is what? This is over absorption. And let's say you are carrying forward it to costing P&L account. Where will you write it? To costing P&L account 10,000. This is what? Over absorption, that is factory overheads to costing P&L. So over absorption is factory overheads to costing P&L account. And if it is under absorption, then what will be there, sir? Then costing P&L to admin overheads. Clear? Any doubts in this thing? Now you may ask that, sir, in this particular question it is not mentioned whether the books are integrated or non-integrated. Yes. Why it is not mentioned? Because one thing, if you see all the entries which are given, which are required, nowhere the general ledger adjustment account was required or the CLC account was required. So whether it is the integrated books or whether it is the non-integrated books, these entries which are asked, these are going to remain same, sir. There is not going to be any change in these particular entries. So that is why it is not mentioned that whether these are the integrated books or whether these are the non-integrated books. Okay, so move on to question number 4. Let's see. Service costing. A transport service company is running 5 buses between 2 towns which are 50 kilometers apart. Okay. Seating capacity of each bus is 50 passengers. The following particulars are obtained from their books for April 2023. Wages of driver, conductor and cleaner, salaries of office staff, diesel, oil and other, and repairs and maintenance, taxation, depreciation, interest and other expenses. Actually, passengers carried were 75% of the seating capacity. Right, sir? All buses ran on all the day of the month. each bus made one round trip, that is 2 single trips, calculate the cost per passenger kilometer. So for this, first you need to calculate as what is the passenger kilometer. Now before we move on to the calculation of passenger kilometers, I want to ask you one very simple question. Sir, this cost, whether this cost is given for one bus or whether this cost is given for 5 buses, my simple question to you, just think and then answer. Just think and then answer. You can, before moving ahead, you can write down in the comment section so that I will get to know that how many of you interpreted it right. I am asking whether these expenses which are given is for one bus or these are for 5 buses. Wait here, pause the video here, comment, write down in the comment section what is your answer. Now, these expenses are for 5 buses, sir, because it is from their books for the month of April, and in the books you will be writing down the expenses related to all the 5 buses, isn't it? Until and unless it is specifically mentioned that these expenses are related to one bus, right? That means these expenses are for 5 buses. That means the passenger kilometers, these passenger kilometers is also to be calculated for 5 buses. How will you calculate passenger kilometers? Very simple. That is 5 buses, right? What is the distance that they carry? 50 kilometers, right? In one day, how many times they are traveling 50 kilometers? 1 round trip, or I can say 2 single trips, right? Right? Any doubts? Fine, sir. What is the seating capacity that they normally carry? 75% into 30 days, because we are talking about the month of April, right? And these expenses are also given for the month of April. So this is how the passenger kilometers will be calculated. 50 multiplied by 2 multiplied by 30, that is 11,250 passenger kilometer, right? Let's see, I hope it will be correct. No, number of trips 30, 1 second, 50 kilometers, okay, 50 passengers also, sir, we have not taken the passengers, sorry, 50 passengers also, 75% capacity to kar di sir, passengers liye nahi, that comes to, sorry, my mistake. Now this is passenger kilometer, this is not passenger kilometer, this was only kilometer multiplied by passengers, that will give you passenger kilometers. Clear? Rest is simple, the cost is given, cost divided by passenger kilometers will give you what? Cost per passenger kilometer. Clear? So rest is the total cost. Now there is a confusion that, sir, how to decide whether that is a standing charge, that is a fixed charge. Now if you talk about this standing charge is what? It is the fixed part, it is the fixed cost. Now there is a confusion, sir, whether what is fixed and what is running and maintenance, that is a variable part. If you are confused, then do not bifurcate. If you are sure, then bifurcate. Repairs and maintenance normally is a variable cost, because the repairs will depend upon the kilometers or the usage of the bus. Diesel, oil and other things, obviously it is going to be a variable cost. It is dependent upon the kilometers that your bus will be traveling. Total running and maintenance charges is very much dependent, okay, it is the total that is given, sorry. And secondly, depreciation can also be taken. Here wages of salary, it is going to be fixed. Salaries of office staff, it is going to be fixed. Taxation, insurance, fixed. Interest and other expense, fixed. Depreciation, assuming that the depreciation is based on time and not on the basis of the running of vehicle. If the depreciation is based on the running of vehicle, then it will be a variable charge, right? Okay, so we are done with this part. A part is done. The second part is regarding the contract costing. Now for the CA students, the contract costing is already deleted from the syllabus, but it should have been there anyhow. CMA students are ahead of it, that's good. A contractor has undertaken a construction work at a price of rupees 5 lakh and begun the execution on 1st of January 2023. The following are the particulars of the contract up to 31st of December 2023. Now, whenever there is a question on contract costing, the first thing that you have to identify is the two dates, when the start of the contract and the closing of the books. I'm not saying the finish of the contract or the end of the contract, no. I'm saying when the date on which your contract is starting and the date of the closure of the books. These two dates are really important, right? So you have to be very careful with these two dates. Machinery is there. Machinery is a fixed asset. Okay. Material, wages, direct expenses, uncertified work, wages outstanding will form a part of wages only. Value of machinery on 31st of December. Now this will give you what? This will give you a depreciation of 8,000 rupees. And I told you in the contract costing that in the contract account we have to consider what? We have to consider the depreciation only, sir. Right? The fixed asset, because contract account is what? Contract account is a sort of profit and loss account. Do you take a fixed asset in the profit and loss account? No, sir. What we take regarding the fixed asset, we take only the depreciation. Right? Overheads are given, material returned is given, which will be on the credit side, work certified is there, cash received is there, materials as on 31st of December, the closing stock of material in hand is there. So a simple contract account you can prepare, right? There is no issue in the preparation of the contract account. Depreciation on machinery, material is given, wages given, outstanding wages, it will be added as a part of wages because it is a expense of this period only. Whether you are paying it in the next period, even if it is an outstanding expense, it will be taken up in this particular period only. Direct expenses, overheads are there, material return, material at side, and the total cost of construction is 342, right? This is the total cost, this minus this. Now on this cost of construction, there is work certified that is given to you and there is work uncertified, that is the WIP value. From here notional profit will be taken up, right? Simple question up till this point. Now what is the further information that is given to you? It was decided that the profit made on the contract in the year should be arrived at by deducting the cost of work certified from the total value of the architect certificate, that 1/3 of the profit so arrived at should be regarded as a provision against contingencies, and that such provision should be increased by taking to the credit of profit and loss account only such portion of the 2/3 of the profit as the cash received to work certified. Sir, all this makes no sense. Basically what you have to do is you have to identify that how much out of this notional profit is to be transferred to the reserves and how much is to be taken to profit and loss account, right? That is based on what? Now for that you have to see what? You have to see what, sir? You know what you have to see? Degree of completion is 50%, right? So the amount transferred to profit and loss is 2/3 of the notional profit into cash received by work certified. So first you have to do what is the degree of completion. This project is for how much? The project is for 5 lakh, certified is 3,90,000, more than 50%, right? But less than 90%. So it will be 2/3. That is what he is saying. Only such portion, that is 2/3 of the notional profit in proportion to the cash received to work certified. This is what we normally do, sir. This is cash received, this is work certified. So first is degree of completion. Accordingly also it is 2/3 only, 2/3 of the notional profit into cash received by work certified. Any doubts? Clear? Okay, so next one, this is 4th we are done with. So please be very careful while dealing with the small points. Even in the contract costing, be very careful with the depreciation point. Please, another way of presentation of depreciation is you write here to machinery 30,000, right, by WDV of machinery 22,000. If you write it this way, this is also absolutely correct, because this way also signifies or denotes what? The net effect of this will be what? The net effect of this 30,000 and 22,000 will be nothing but this 8,000 of depreciation. So you can write it this way, or you can directly take it as depreciation as they have done in the solution. It is totally up to you. Both these presentations are absolutely correct, right? Nothing to worry. And one thing regarding the outstanding wages, this also you have to be very careful with. In case there are prepaid expenses or the prepaid wages, prepaid means the expense is of the next period, you have paid in advance. What will you do? In that case, you will write here wages, add outstanding if any, minus prepaid. This can be with the wages also, this can be with the expenses also, the other overhead, the direct expenses, the same thing can be there. So you should be very much clear with the treatment, that what is the treatment that is required. Okay, moving on to the next one, that is question number 5, A part. In manufacturing, the main product A, the company processes the resulting waste material into two byproduct B and C. Using the reversal cost method of byproducts, prepare a comparative profit and loss statement of the three products from the following data. Total cost up to the point of separation is 68,000. That is, this is the joint cost that is given to you. This is what the joint cost that is given to you. Sales, all production. There is no closing stock or nothing. Whatever you are producing, you are selling, right? For all the three products, these are the byproducts, right? And this is your main product. Estimated net profit percentage to sales value is given. Estimated selling expenses as a percentage of sales value is given. Cost after separation, that is further processing cost, FPC, that is given to you. Now in this particular case, when you have a main product, you have a byproduct, and which method is applicable? Reverse cost method is to be applied. How will you apply it? You will start with the byproducts only. You will start with the byproducts. What is the sales? Reverse. You have to go reverse. I have discussed in detail on the YouTube lectures itself. It is discussed in detail, sir. You have to start with the sales, go reverse. Sales is there, profit is there, you will get total cost minus the further processing cost, or the selling and distribution cost is there, right? Further processing cost is there. What you will get is the share in the joint cost. This is what you will be getting. Okay, let's see A part. Sales given to you, less profit, total cost. Out of this total cost, first you will subtract the selling expenses, right? And then the further processing cost. What you will get, the balance is what? The balance is whatever the share in the joint cost. Now what is total joint cost? Out of that, 4800 is for B and 4800 is for C. So that means the remaining joint cost of 5800, 400, this belongs to what? This belongs to the main product A, right? Then the profit and loss statement. The sales are given, joint cost we have just calculated, cost after separation, selling expenses, total cost, and the profit that you will get. So this is very important, sir. This part is important here. Always remember, whenever it is the byproducts which are given to you along with the main product, and it is the reverse cost method that is asked, in that case you will start with the byproducts first. Forget about the main product, just start with the byproduct first, right? And in those byproducts, start with the reversal method. Start with the sales minus net profit, you will get total cost. Out of that total cost, you are separating what? The individual cost, the selling expenses, the further processing cost. Whatever is left is what? The whatever is left is your share in the joint cost, right? The remaining cost is what? The remaining is out of the joint cost only. Clear? Okay, so this is question number 5, A part. Let's move on to the B part. Using the following information, calculate each of the three labor variance for each department, department X and department Y. Gross wages are given to you, standard hours produced, standard rate per hour is given, the actual hours worked is given to you, right? Okay, so what is there? This is the actual payment that is given, actual cost, right? This is the actual hours which are given. This is the standard rate that is given. Now this part is important. This is what? This is the standard hours produced. Read the word what is given. Fantastic. He says what are the standard hours produced. What does it mean? It means these are the standard hours for the actual production that is given to you. This is what? This is the standard hours for actual output that is given to you. Very important. This is not the standard hours for standard output. It is the standard hours for the actual output that is given to you. Rest is simple. Standard rate is given, actual hours is given, actual cost is given. You can calculate all the labor variances, right? Labor rate variance, labor cost variance, and labor efficiency variance. All the three variances you can easily calculate, right? So only important point here was that the standard hours produced, the produced means these are the standard hours given for the production. Whatever you have produced, that is the actual output, right? So move on to the next one. Sixth one. Let's see. S Limited furnishes you the following information relating to the half year ended 30th of June 2023. Fixed expenses are given 45,000. This is for the half year. Okay. Sales is given, profit is given. During the second half of the year, the company has projected a loss of rupees 10,000. Calculate the break-even sales and the margin of safety for the 6 months ended 30th of June. That is for the first half. You have to calculate the break-even sales in value terms only, right? So fixed expenses are there. For the break-even sales, what you need? If I want to calculate the break-even sales in rupees, what do I need, sir? What do I need? I need fixed cost divided by PV ratio. Isn't it? I need what? I need fixed cost divided by PV ratio. How will I calculate PV ratio, sir? How will I calculate PV ratio, sir? Sir, profit is given, fixed expenses are there, so you will calculate contribution here. The contribution will be 75,000. So what will be the PV ratio here? That is contribution 75,000, 1,50,000 sales into 100. Right, that comes to 50%. So what will be the break-even sales? That will be fixed cost of 45,000 divided by 50%. 90,000 is your break-even sales. So what will be your margin of safety in rupees? That is total sales minus break-even sales. Total sales is 1,50,000 minus 90,000 is your break-even sales. So 60,000 is your margin of safety. Now it is for the first half of the year, that is for 30th of June. Please be very careful with the dates. Okay, so let's see if it is correct or not. Absolutely correct, sir. Margin of safety and break-even sales. Second part, expected sales volume for the second half of the year. Okay. Assuming that PV ratio and fixed expenses remain constant in the second half of the year also, right? PV ratio remains at what? 50%, sir. Fixed expenses remain at what? Same 45,000, sir. Can you calculate now? Can you think of some calculation? What is required? The sales volume is required, sir. Very simple. What is there? Sales is equal to contribution by PV ratio for this is for the second half of the year, right? How do you calculate contribution? See, listen to it very carefully. What is given for the second half of the year? Second half. Sir, what is the fixed cost? What is the fixed cost here? The fixed cost is given as 45,000. Isn't it? For the second half of the year, the loss is given. What is the loss that is given? 10,000. So can you tell me what will be the contribution? 35,000. Isn't it? Contribution is fixed cost plus profit. In this case, the profit is negative, that is minus 10,000. So contribution is 35,000. Now what is PV ratio? PV ratio is contribution by sales into 100. PV ratio is 0.5. contribution is 35,000 divided by sales. So what will be the sales for the second half of the year? That is 70,000 is the sales for second half of the year, right? 70,000 is going to be the sales for the second half of the year. No such calculations required, sir. What he is asking you only about the sales volume that is required. So that is what we have calculated, sir, 70,000, right? That is what is required. So no point of doing some extra calculations or something like that. Last part, the break-even sales and margin of safety for the whole year 2023. Now, if you talk about whole year, break-even sales is what? Break-even sale is fixed cost for the first half of the year plus fixed cost for the second half of the year divided by PV ratio, that is 50%. So that will be the break-even sales, that is 90,000 divided by 50%, that comes to 1,80,000 is the break-even sales. What will be the margin of safety? Margin of safety is total sales. What is the total sales? In the first half of the year, the total sales is what? 1,50,000. In the second half of the year, what is the sales we have just calculated? That is 70,000 minus break-even sales of 1,80,000. This will give you the margin of safety. 1,80,000 and 1,50,000 plus 70 minus 180, 40,000 will be your margin of safety for the whole year. So some of the information is given for first half of the year, some information is given for the second half of the year, some information we have to calculate for half years, right? And then for the complete year. Mark it as an important question, sir. This is a very good question, and this question has been picked from the ICAI module. Okay, seventh question, A part, last question. It is the budgetary question. Very simple. The monthly budgets for the manufacturing overheads of the concern for the two levels of activity are as follows. Budgeted production is given in the units, that is 601,000. Wages, consumable, maintenance, power, fuel, depreciation, insurance, total cost. You are required to inspect which of the following items are fixed, variable and semi-variable. The most important part is here. If you are able to understand this part, rest everything is simple. Then he says prepare a budget for 80% capacity, compute the total cost both fixed and variable per unit at 60, 80 and 100% capacity. Now, how will you identify that whether a cost is a fixed cost, a variable cost or a semi-variable cost? Write down the rules regarding this. When we talk about the variable cost is the one which changes with the change in the level of activity. Do you agree with this thing? Yes, sir, we agree with this thing, right? So what are the features? How do we identify that whether it is a variable cost? Sir, per unit cost will not change, right? And total cost will change, right? For example, let's see the wages here. Let's talk about wages here. Can you tell me the per unit cost here? That is 2 rupees. 1200 divided by 600, per unit cost is 2 rupees. Here, what is the cost? 2 rupees. See, the per unit cost will not change, whereas the total cost is increasing from 1200 to 2000. This is what? This is my variable cost. This is my variable cost, right? Now, regarding fixed cost, what is a fixed cost, sir? The fixed cost is the one where the total cost will not change. It is the total cost will not change, right? But per unit cost will change, right? This is a feature of a fixed cost. For example, let's say depreciation, sir. What is there in the depreciation? Per unit cost 4,000 divided by 600, that comes to 6.67. and here comes to 4. The total cost remains same, whereas the per unit cost changes, right? This is what, this is your fixed cost. Sir, how to identify semi-variable cost? In semi-variable cost, what will happen, sir? Your total cost will change and your per unit cost will change. So a combination of these two, is my semi-variable cost, right? So if your per unit cost is also changing, if your total cost is also changing, in that case, for example, let's say power and fuel, we'll check divided by 600, that comes to 2.67, and here it comes to 2. See, the total cost is also changing, the per unit cost is also changing. So this is what, this is a fixed cost. This power and fuel is what? It is a semi-variable cost. So you have to remember these rules, that how to identify that which cost is a variable cost, which is a semi-variable cost, and which is a fixed cost. This is how we have to identify. We have to calculate the per unit cost. If the per unit cost remains constant but total cost changes, then it is a variable cost. If the per unit cost changes but the total cost remains same, then it is a fixed cost. If the per unit cost is also changing, the the total cost is also changing, it is a semi-variable cost. Clear? Then you have to prepare the budget at 80% capacity. Whatever is the variable cost, vary according to 80% capacity. Fixed cost will remain fixed, sir. Fixed cost will remain fixed. Semi-variable cost is to be bifurcated between variable and fixed cost. Please do it on your own now. Try it on your own once, that how it is to be calculated. Clear? Or should I tell you once that how this semi-variable cost is to be bifurcated? Okay, I'll tell you once that how this semi-variable cost is to be bifurcated between variable and fixed. How do we do this? Let's see. At 600 units, what is the cost? 1600. At 1000 units, what is the cost? That is 2000. Now, for a change of 400 units, what is the cost that is changing? That is by 400, right? For the increase in the 400 units, my cost is also increasing by 400. So this is what? This is a variable cost for 400 units. Can you tell me the variable cost per unit here? That is 400 divided by 400, 1 rupee, right? Now, when you take up this 1600, out of this, some part is variable, some is fixed. How much is variable? 600 units. 600 units multiplied by 1 rupee. 600 is my variable cost. 1600 minus 600, 1000 is my fixed cost. Sir, can I do it with this 2000? Yes. Out of this, what is variable cost? Number of units multiplied by 1 rupee. That is 1000. And what is a fixed cost? 2000 minus 1000, 1000. The fixed cost will be same. Only the variable cost will differ, sir, right? So this is how the semi-variable cost is to be bifurcated between variable and fixed cost. Clear? Any doubts in this thing? Semi-variable cost will be bifurcated between variable and fixed costs. So rest is the theory part. Just go through it with the theory part, right? Just go through with the theory part. That's it. This is done, the first mock test paper for June 2024, and you people have to tell me in the comment section that whether you want it for December 24 also discussion, this MCQ discussion also. Please let me know in the comment section, right? So see you guys in the next video. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.